Hello, everyone, and welcome to another edition of CEO and Market Expert Interviews. I'm your host, Lucian. Some of you know me as Triangle Investor from X. I would like to welcome Trader Ferg back to my show. Ferg, it has been a while since you and I talked. How are you doing?
Yeah, great. Good to be back, Lucian. And yeah, no, market's a bit rough at the moment, but other than that, everything's going well.
Thanks, mate. Great to hear that. Let's start. I want to open this interview with the exact question I asked you in our first interview, and that is, what are the current most hated commodities, and how are you playing them?
Certainly. So at the moment, I have pretty much two obsessions that I spend all my time researching. One is offshore oil services, OSVs, and any sort of rigs. And shipyards. I love that whole space. I feel that is just absolutely hated still. No one, even though a lot of it's starting to work and make money, you can find just crazy value in some of the small, really small stuff like sub 200 million, talking like Singapore, Hong Kong exchanges. So I spend a lot of my time digging through that. And the other place I'm seeing just an absolute ton of value at the moment is in the platinum group metals.
Mm-hmm.
So I've got a whole sort of thesis around that. And it's me, like I see, I just see all the signals that get me extremely bullish. Like I was just reading an article earlier that was Sibanye, a South African producer. They're talking of putting one of their major mines into care and maintenance. And everything I'm seeing is just suggesting there's going to be uh, far higher demand than the market's anticipating moving forward. And I've got like a whole thesis around that. If you want me to launch into that at some stage, but yeah, I'm just seeing that as really hated, really misunderstood, and significant upside. So those are the two places that I've spent a lot of time lately.
Yeah, you said that you're seeing signals. Expand a bit on the signal part. What signals are you monitoring? What signals are the most important to you to make a decision that you will enter the trade?
I love to see people quite despondent about something. Like if I look into the sector, I'd like to see that people people aren't bullish. They aren't jumping up and down about it. It's one of the most like simple approaches I have is I'll always defer to something that's more hated. Um, granted, I do the work and understand the fundamental case, but I always want to work out what's at the bottom of the list for what people um, expect going forward. And if you can hang out there, then you don't actually have to be that right to have good returns. And this is similar. I think I've referred to Koala. He's on Twitter,
Hmm.
and he observed. He was just looking at some of the recent coal deals and some of the recent copper deals, and he was saying the market's prepared to pay $3 uh, for $3 a dollar for $3 of copper cash flow versus only a dollar for that same cash flow from coal, and that's just that. I just always want to find that thing that's just disliked. No one expects it to do good things, and demand will keep surprising to the upside. The supply story is easy to wrap your head around. Everyone thinks it's not going to be required, and so they're not putting the necessary capital. Like that's a good example between copper and coal. With copper, there's a solid case for why it's needed, but there's also the fact that everyone understands that. And so all the majors are acting on that understanding. They're all throwing capex at it. They're doing all they can to rectify that situation. We have something like coal where we've convinced ourselves we're not going to need it. It's been capital starved. you
Yeah.
keep forever seeing forecasts that it's going to be in decline when that's completely against reality. And so that situation, that capital starvation, is going to show up down the line, and that, all of things being equal, will mean better price appreciation, better performance. And also when you go in now, you have a bigger margin of safety. And so that's what I need to see. That's where I start. And this often starts with charts. This is looking at why is something bottom crawling? Why is it just so out of favor? And then, really digging in and trying to understand, is the market perception of it wrong?
Yeah, is the important piece of the puzzle also sentiment on social medias? Do you track that?
Yeah, I do to a certain extent. Like I get a lot of value out of some of the names um, that are often associated with the sector, just like typing the ticker into the likes of Twitter and seeing what the general feeling is. Like I actually like to see, like, a lot of people, like, I'm done with this. Like, this is it. Like
All
I
over.
the longer I'm in this game, the more I appreciate just how just the role that it often plays. Like, people, I've often used the example of uranium and coal and some other commodities I've owned, and how that often go sideways until you've got the tourists out from the last run up. Like, it has to try sideways until people get disillusioned enough. The people that haven't really done the work, that just hopped on the ride because it was going higher, they have to be washed out. And sometimes that can take a year, 2 years, that could take even 3 years if they really thought they understood the thesis and will hang in. And that's why you often get like that stepping up pattern in the markets. You can have things really run, like an example could be like uranium really ran in that late 2021. And before you could have the next leg higher, you had to work out a lot of the people that had just jumped on the train and were expecting whatever they want, £1,000 uranium or whatever, and to see them trickle out, and then fundamentals take hold again, and then it's the next leg higher, and then they all pile in again once they see the price action. Yeah, I was even just looking below unfortunately I didn't have time to watch it yet, but with Mike Elkin, you recently interviewed him.
Yeah.
And I was just interested. I always like to scroll the comments and try and get some signal from that. And there was a few comments like, screw this trade, like, I've been in this for so long, like, it's still lower than like 2021, like, yeah, I'm out, this is never going to work. Like, none of them are actually talking about the fundamental case. And it's funny because it's under a video with like the guy that does the work. Like, Mike Elkin is just, he lives in his spreadsheets, he leaves no stone unturned, and yet everyone's just essentially saying, yeah, the price action hasn't lived up to my expectations, so I'm out of here.
Yeah, agreed on the comments. I usually also read the comments when I watch the interviews of certain guests, and really it shows me a few things, like you said. I agree on that. Ferg, let's cover some commodities, and I would like to hear your comments on them. And I want to start. You mentioned uranium. Has your position changed here? How much of exposure you have in uranium?
So no, uranium's still my highest exposure. A lot of that has come from price appreciation. So I always say, if I was to be given cash and reweight today, it would probably have a lower exposure. I'd have a more even weight between the likes of uranium, coal, oil, platinum group metals, tin. But yeah, as of now, it's by far my most significant exposure, and I'm still very bullish. I keep an eye on the supply demand. I've got like a try and track all the developers and what they're guiding, and have a sort of a pretty conservative demand forecast. And I just want to see how those two things can match. And when I take this out to 2030, it looks to me like there's at least a 20-25% gap between them.
Yeah.
And this is before you start drawing lines through certain developers. Like, you can, draw a line through Govex, like maybe they get it back online like 2030 or something if you're pretty optimistic. And then you've obviously got others that you push back, like Global Atomic, you can push that back. You've got others that are actually just missing the start of what they guided, and so you got to push that back. You've got some that are just obviously in no position to even hit what they said they can do because of where they're standing in terms of financing. And so as you just shift the whole supply spectrum back, I don't know how that fixes itself without the mining, the developers being incentivized with capital flows, and the way that will occur is with price action. And I think that's quite logical, really. I'm always puzzled by people that sort of say, oh, you just want to be in spot, and spot will do something crazy, but the miners are, there's no value in miners. I was like, oh, that doesn't work. And there could be an argument for that if we were seeing the majors really ramping, but what we're seeing out of the likes of Kazatomprom, like their miss in 24 and what's coming in 25, it's almost certain in my books that will wipe out what all developers have guided to do in 24 and 25, and some. And that's just, I'm not ready to head for the exits until I've seen the price appreciation that'll help fix the supply-demand problem occur. And once that starts to occur, then I've got a very clinical exit. I start taking slices out of taking chips off my positions quite gradually and just exit over time as I see certain signals get hit.
Yeah. How are you playing uranium equities? You don't have to mention any names if you don't want to, but do you have the majority of your position? Are there developers, producers, or explorers?
Certainly, anyone can actually see what I own because I wrote about it on my free blog back in 2020. So my largest two positions are Paladin and Boss Energy, and bought them in 2020 and have rode them to now. And from there, it's just a smattering of developers. I really did try and I owned more developers at the start, and then when I saw a lot of the cost inflation across, I really cut it back to only a handful that either already had spent quite a bit of capex and potentially already had some infrastructure in place, or that I had pretty high confidence in the management teams, or that it was just almost a speculation on like a retail frenzy. I do have a little bit of like sort of joke, it's like shitco or moose pasture, but I do think you want like a sort of 1% or 2% of that in case things get crazy. And that's how I've been positioned. I haven't done almost anything in uranium since 2021 really. So I've just took all my positioning and have really spent the rest of the time, like 2021, I was looking at mainly coal and really building up my coal positions. And then more recently, I've kind of moved on to the oil and now some of the sort of precious metals or platinum group metals.
Yeah, let's discuss precious metals. What's your take specifically on silver?
So I'm bullish silver. I think it's essentially a derivative on gold, and I'm quite bullish gold now. I've got like a sort of come round to the whole gold thesis because for a number of years I didn't want to touch it. I saw it as sort of a political metal that was always going to be managed. Every time there was more demand, that would be managed with the paper supply increasing. And so you never really got price discovery. And so I was like, I don't want to be involved in this if it's always going to be managed. And what I've seen more recently, and this is on the back of a lot of what Luke Groman's talked about and also Lewis Vincent Garve, is the fact that you've seen a pretty consistent bid in China on the Shanghai, and that's starting to suck a lot of the physical across. And the sort of rationale for that is that they plan to increasingly net settle in gold moving forward. So if you will, sort of gold will be the new sort of developing market currency, because they want to disentangle themselves from being tied to the US dollar after what happened to Russia. They need their own sort of system, and they need the US dollar not to be a bottleneck for a lot of their trade. And so this is sort of the idea of, like, if we've already seen it with more and more trade, whether it's in commodities between Russia, between China, even Saudi, they're prepared to do trade in each other's currency, goods for goods, and then net settle in gold. That's just going to drive up the demand for gold, and also it'll be actual physically settled gold. And whoever controls kind of settlement ultimately controls the gold price. And so I see that being taken off the West, and that'll literally lead to the destruction of the paper market. And so if you kind of see that, then you inherently have to have quite a bullish view on gold. And then silver is will get dragged along with it, and it's a lot more illiquid. People, the gold price does something crazy, people pile into silver, and it'll probably do something even crazier. So yeah, bullish both, and yeah, want to own both physically moving forward, as well as find some exposure in the stocks where I can.
Yeah, but from traders' perspective, would you say that gold is at almost at all-time high? Would you say that this is a still good entry point to enter as a new investor in the trade?
Yeah, so I kind of view it differently, in that it might be revalued quite significantly. So take this with a pinch of salt as well, because in my portfolio I've only got maybe
Sure.
two, like I own a company that has a proportion of its revenue via gold, and that position's only 2-3%. So this is a very low weighting. So that's kind of I'm not throwing a lot of money at this, mainly because I don't like investing in gold miners. I don't like being in miners in general. And so but I see gold price revaluing significantly if it's to fulfill the role of having more trade settled in it. And it's in everyone's best interest as well. Like, if anyone sort of goes through history, the US, going right back to the 1933, when they confiscated gold, they then revalued it significantly. They took it from 20 to 35 an ounce, and that gave them huge profit, which helped them sort of recapitalize themselves, and I guess you call it. And I kind of see that playing out again. Like, they've got 8,000 ounces, 8,000. That was it, 8,000 tons. I'd have to double check with the Fed, and that obviously would be a windfall if that gets revalued significantly. And then China and Russia have got very large amounts as well. But yeah, overall, this is all nice sounding theory, but I'm not actually putting that much money to work on it. I just want to have some exposure to it, and if this plays out. So yeah, that's how I'm viewing it.
Do you have some money invested in copper? What's your take generally on copper, and do you have investments in copper?
So I like the copper bull thesis. I think it will play out. I think there's going to be solid upside in copper. I just don't like it as much as some of the other commodities I've talked about. I don't own any copper at all, and I just feel it's too well known. And as I talked about earlier, I think too many people are kind of acting on the knowledge, and so as a result, your future returns are not going to be as high. I always like it. If there's like a spectrum of demand versus supply, you've got kind of like inflated demand, and I would have said that was like the likes of some battery metals. I always question the demand assumptions for the rate of EV adoption, but also who is going to be the winning battery chemistry. Like, that's quite a hard call to make, and anyone that loaded up on lithium's had a pretty hard time on the back of that. And then I kind of see copper is kind of at the bottom of that pile, where its demand's probably slightly inflated if the my view on like kind of the whole net zero movement's not gonna is gonna ultimately fail. And but then yes, it's still solid. There's definitely still supply deficits out there, so I think it does well. I just don't see it doing well as something like a like oil, like coal, and especially when you can buy the equity so cheap. Another problem with copper is how you apply the view. I've got someone I really respect, chatted to him about WhatsApp on it. He's like, copper's about to run, and spent a whole afternoon trying to work out how I play it, and I couldn't find anything I liked. Like, bull calls were expensive. I didn't want to buy the straight miners. It was too much sort of geopolitical risk. And so, yeah, ultimately I passed on it.
Okay, do you believe that there is still an opportunity for oil as investment, I mean?
I hope so. Yeah, I've got a dirty big chunk of my portfolio in it. So yeah, no, I'm definitely an oil bull. I think there's some of the greatest value at the moment in the market in that space. Some very cyclical companies that are generally tied to offshore, in which it's long cycle capex that's largely been capital starved due to shale, and also due to the sort of the net zero or decarbonize, the sort of the transition movement, if you will, is the idea that that's going to reduce oil demand, and I just don't see it. I think oil demand is going to keep putting in strong growth for decades to come. If you look at the sort of the developing world, like a way I always like to just frame it is a lot of what we hear mentioned is quite sort of Western or developed world centric. But when you consider that developed world's 1.6 billion people, we consume 12, 13 barrels per person per year, and our population is going nowhere. Like, it's literally population growth is pretty anemic. And then you compare that to the developing world, and that's another 6.5 billion. They're going to add another 2 billion people by sort of 2050-ish. And they're currently, across that 6.5 billion, they're consuming 3 barrels per person per year. And that, if you just add the population growth, add the 2 billion people, then that's gonna literally add 50% to the whole energy demand. And then if you assume, like every developing country is, that they're trying to increase their standard of living, be it China, be it India, then if they get themselves from 3 to 4 barrels per person per year, then that adds another 50%. So then you've doubled the whole energy system. And that's just what I'm positioning for. And I'm seeing, I think shale's growth behind it. And even if it kind of flatlines here, I see, energy demand keeps surprising to the upside, and more supply needs to come on, and that's going to be via offshore. And offshore's been left for dead, so you can pick up a lot of these businesses crazy cheap, and often post bankruptcy as well, which is the most exciting, when they acquire a lot of assets and then write them off in a restructuring, and then you have them ready for the sort of the cycle to kick in. And I think that's a beautiful setup.
Yeah. Ferg, what about tech stocks? Are maybe tech stocks a good buy right now, or too many FOMO?
It's not my space. Yeah. I've never really thought I had an edge there. And yeah, I feel they're too loved. Yeah, too much FOMO, if you will. And I just like to stick to stuff that's hated and I can value as well. I've got a pretty small circle of competence, and whenever I go outside, I do something dumb. So I try and stay within stuff where I can literally like work out what's this worth. Like if it's a drill ship, I want to know what will it cost to rebuild this? What's it priced on the market at the moment? How long will it take to rebuild it? How many of them are in the world? What yeah, just absolutely build a whole understanding around that. And then that allows me to really build conviction, because a lot of the stuff you have to have conviction if you're going to hold it through pretty crazy volatility. None of the stuff's easy to hold. It's why you see all the angry in capitals comments on a lot of the stuff. Like
Yeah.
it's 50% drawdowns, nothing in a lot of these names.
Yeah, agreed, definitely on that. Do you follow real estate market, maybe?
Yeah, I do. So that's my history was in real estate. When I first moved to Australia in asset management, I was managing a real estate portfolio when I first got into asset management. And yeah, I'll put my hand up and say I've been awfully wrong on a lot of it for a long time. I thought Australia was quite overvalued when I left, and that was that was over 10 years ago, and it's gone nothing but vertical. Same with New Zealand. Like every
Yeah.
time I'm like, that doesn't make sense. It just keeps going. And so I'm still in the bearish camp. I think ultimately the way that particularly Australia and New Zealand, the way they don't have the luxury of like the US where they can lock in like 30-year fixed rates, since the rates always the maximum you can lock in is in 3 years. And so those constant sort of refinancing or remortgage, having to sort of bear the brunt of the higher rates, and especially when the market is so expensive, I think that's ultimately going to lead to a pretty nasty situation where there'll be more and more sort of non-performing loans or people that can't afford their mortgage. And Australia and New Zealand get a lot of their money off the international market, and so they'll be perceived as riskier. The rates will go up that they lend at, and then there will be more non-performing loans, and it'll be a nasty feedback loop. And so it's kind of, I look at that as potentially on a long enough time horizon, there will hopefully be some real value there to buy on the back end of this. But that's probably a little way out yet.
Yeah, I see also a lot of red flags when it comes to real estate market, but just like you, I'm like for the last 5 years, I think that they are overvalued and the price just keep on going up. Agreed 100%. Ferg, what about cash? How much of cash percentage should one investor have if he wants to take advantage of the, let's say, pullbacks on the markets?
Yes, I don't carry almost any cash, so I'm always pretty close to fully invested. Maybe at my account at any time I have maybe 3-4%. I actually just wrote recently a post for my Substack, and that was um, I was talking about how my way of often almost carrying cash is I find like stupidly cheap stuff. And so the company I was talking about yesterday was it's just a random company in Hong Kong that has a negative EV. So you've got more cash than market cap, get a 16% dividend, and owns a coal mine. And so I have these sort of like crazy positions where I just don't see that much downside. Like how much more negative is this company going to trade? I have it in a few coal stocks that have I just see them as dirt cheap, or maybe even one offshore stock I'm thinking of that's got a large percentage of its market cap in cash. And I kind of see them as something that hopefully I can liquidate and go in with a more leveraged name if I do get a nasty drawdown and see some real opportunity. But most of the time, I just stomach volatility. It's always my thing. I just accept that I'm not going to be smart enough to see market crashes or any of that. So my advantage has always been I don't use any leverage in the account. So if things get really nasty, I can just ride through it. I understand what I own, and I'll just try not to look at my account for a period until come out the other side of it. And yeah, I forget who said it, but it was I think in a lot of the circumstances, more money's been lost trying to anticipate like market crashes than actual market crashes. If you were just in a position to ride through it, you're not on margin, you're not going to get margin called out. If you just accept that you'll have some nasty drawdowns and then it'll bounce back. That's always been my approach. Every time I hedge, I just get annoyed because I wasted like 1% or 2% on protection that I could have put into something that a small sort of offshore service company that could quietly just become a multi-bagger over sort of a 3 to 5 year period.
Yeah, got it. But Ferg, do you really see a major correction or market crash in 2024 or 2025?
Um, Possibly. I wouldn't really put any weight in my opinion on that. I see a lot of things that don't make sense to me, like kind of how does the market rebalance with the sort of passive side having driven it so much? Like who's going to be there to take this sort of Mag 7 off passive when the when active managers have got so crushed, and the very fact of the index having to rebalance will mean something's probably outperforming, and so the active side will be all over what's outperforming. And so who's going to be taking sort of Nvidia off their hands at sort of 24 time price to sales. I was just looking at sort of a comparison last night where Nvidia's 24 times price to sales, and Cisco was 26 times price to sales back in the dot-com boom. And then the market decided from then on for Cisco it was about 3 to 4 times price to sales for the next decade. And I could see something similar happening to Nvidia. And but when that'll happen, then I've got no insight into that. I can't play it, so I'm just throwing around theories that everyone should largely ignore.
Yeah, but what do you see as the next black swan event in the economy or on the markets? Do you see any?
Main black swan I just see is that everyone's pretending inflation's is in the rearview mirror. I see inflation coming back, and I see it being super sticky. And what always happens is once consensus decides inflation's there to stay, a lot of the higher multiples have to come down to a level that they can justify in a highly inflationary environment. There's always this kind of view that all equities will do well in inflation, but that's not true. If you look at past inflation, they do well once the valuations have come down and everything is at a valuation that you'll do okay with said inflation level. But there can be an awful lot of destruction if you've got a really high multiple, and then inflation is going to be in the high single digits, and consensus all believes. Then there's a lot of stuff that has to be re-rated. Like one of my favorite examples was from the Shrub when he just spotted for whatever by whatever fluke. I think it was Peabody earnings announcement was 724 million, and at the same time ARM Holdings also announced earnings, and that was also 724 million, and yet Peabody was sporting a 3.4 billion market cap, and ARM's was 100 billion. And it's just and he had the great title, like was it a dollar of earnings? 724 million. 724 million is worth 35 times more in the metaverse, which is just a way of saying like there's a lot of enthusiasm for that space, and they're willing to pay 34 times more for it, which history shows you generally get punished on those sort of assumptions. Which is why I kind of hang out and stuff like Peabody.
Okay, Ferg, final question, and that is actually not my question. That is a question from one of my follower. What is your biggest gain ever, and what is your biggest loss ever?
So my biggest gain ever would be, in total nominal amount, would be Paladin, but I've got a funny story, so I'll tell it anyway. For biggest, in terms of like percentage gain, was actually Liontown, which is a bit of a joke because I have sometimes when I look at a position and I like the story, I like the chart, I just throw $1,000 on to make sure I kind of come back to it and don't lose sight of it. Like once it's in the portfolio, I'll probably get around to researching it, And if the chart looks like it's about to run, then that's not an amount of money that'll kind of keep me up at night. And so it's almost like a placeholder. And so for whatever reason, I did this with Liontown back, it must have been like 2018, 19, and meant to get round to it. Never did. And just always, every time I look at it, I'll be, oh, that's interesting. That's doing well. And anyway, come, I think it was last year, it was over 100 bagger. And
Wow.
so, yeah, that's the largest return. And I had the embarrassment of having done so little work on it. I thought it was in copper and nickel. So I didn't even know what the mine actually did. I'd done that little work on it, and it was just sitting in the corner of the portfolio. And the interesting side of that is, like, I talked to my mentor about it. I was like, oh, that was so silly. I should have, at least when I saw it really working, I should have done some research. I should have sized it up. And he was like, yeah, well, if you'd put a proper position size on it, you would have sold it at like a 5x, because you would have seen something else you like more, and the relative value, you would have shifted across to some cold aim or something. And so it needed to be small enough, and that I really let it get away on me. So yeah, that's a silly story of getting luck.
It's a great story, and I have a headline for. I have a thumbnail. What's Ferg's first 100 bagger? So I believe that would attract a lot of views.
Oh God.
Yeah.
Well, that was just absolute stupid luck. Yeah, I've often got a saying that a lot of this, it's 50% asymmetry, 50% luck, and the rest is pure insight and skill from myself.
Yeah, but we all have to have some luck in our trading. That is an important piece of the puzzle, I believe. Ferg, thank you for coming to my show. It was a great chat, and I look forward to host you again.
Thank you so much for having me.